everybody. Welcome today to Cam Matrix Chat with Michelle Newton of Insurance Office of America. This is kind of your intro, Michelle, to the Cam Matrix. Say hello to everybody.
Hi.
I've known Michelle for a little over 2-3 years now, through Building Managers International, and she's very knowledgeable in the insurance industry. She's been a licensed agent for quite some time, very extensive knowledge in flood insurance, and today I asked her to be on here with us because I've heard a couple of things here and there. I've seen a couple of articles about what the insurance industry is doing as far as guidelines goes with community associations. We know it's a hard market. And just to explain to managers out there what that means is that basically, look, the insurance companies are, I think, now Michelle, correct me if I'm wrong, but it's kind of like the insurance underwriters are saying, well, you may not fit this year, but if you do, we're going to hike you up a pretty good bit because we've been hit and now we want to get our money back. Is that okay to say that? Is that okay?
I mean, insurance companies, insurance carriers, they're for profit. They're not a charity organization. They're in it to make money. They're in it to make money for their shareholders. So I think when we take it personal, I take it personal when I get a rate increase. I said, well, I have never had a claim. I've been with you for 10 plus years and now I'm getting a rate increase or you're dropping me. And a lot of people will take that personally. But at the end of the day, they're looking at profitability. They're not looking at, oh, well, they've just been so nice to us that we're going to keep them on. So going into this hard market, which really started to teeter and progress into that hard market since 2017. So look at after Irma, because 2017 was the worst year on record for catastrophic losses globally. And it hasn't gotten much better. And that's the problem, is that we're still having wildfires, we're still having tsunamis, we're still having hurricanes, we're still having all these different types of disasters. And it doesn't seem like it's going in a positive direction. It's just continually going in a negative direction. So the underwriters and actuaries are updating their modeling systems to account for climate change and the way the world is changing. And then a nail in the coffin came COVID. Okay, because now we have COVID that's causing business interruption claims, which are almost all going to litigation. We have general liability claims, people saying, oh, well, I got sick at your place of business. Workers' comp claims saying I got sick at my place of business. And then we have life insurance, health insurance. So all of those different things together affect the marketplace and then eventually trickle down and affect the consumer.
And the first thing that the consumer says is, but I haven't had any losses.
Right. And if you have losses, it just makes your situation worse. So with losses, you'll probably get a non-renewal instead of a rate increase. Over the last few years, 2 to 3 years, American Capital, which used to be AM Best, A-, excellent rated within 60 days when insolvent. American Platinum stopped writing new business. Bankers stopped writing HOAs. They wrote a ton of HOAs.
Yeah.
They're no longer writing them, and they're non-renewing all the ones they have on the books. Great American, that was the property carrier for Surfside, is no longer writing in Florida. Everest stopped writing in Florida. They used to do a lot of high rises. Tower Hill was downgraded from A- to B++. So now that causes an issue for those umbrella policies, because most umbrella policies won't go over a B++ carrier. Weston requested in the end of 2020 for AM Best to stop rating them because they were considerably getting downgraded. So they just don't rate us anymore.
Oh my goodness.
That's always an issue. And now they're issuing a lot of non-renewals. So that's a big red flag. And the carriers that we're left with are issuing non-renewals on the ones they just don't want to keep on the books. And the ones they do want to keep on the books, they are increasing premiums, increasing rates, increasing deductibles, limiting coverage. Some of them are taking away replacement cost on the roofs if the roofs are a bit older and saying we're only going to pay you actual cash value on that roof. Some of them are saying we're only going to pay you actual cash value on the whole building if the roof is old. So that's an issue. And then the carriers are also updating their requirements for taking on any new business.
And the actual cash value, it basically says, look, we're going to depreciate the value of your building.
Correct.
So you might have a $5 million building and you might be lucky to get $2.5 million payment out of it. You just don't know. There's a whole calculation involved in it.
Yeah.
What type of increase are you seeing on your renewals?
average now is still if you look at as an overall for all policies together, if you add them up, average is still around 20 to 25%. Some of them are less, of course we always try. And then some of them are way more. Some of them are doubled, some of them are tripled. So it really depends. And that all goes to what type of construction, where they're located, what their claims are like, on whether or not they can still find coverage in the standard market, or if we have to put them with Citizens. I mean, some risks are having to go back to Citizens, and Citizens is designed to be the most expensive. So when we go that route, it's because there's really not another option that's viable for them.
I really dislike Citizens because you lose a lot of your authority to assist the client when you have Citizens involved, because they're just so non-responsive to even the agents when things occur because they're Citizens. I also worry, do you think Citizens has enough money to cover losses? That's always been a question.
They'll just assess every other policy, basically written in the state. So they have unlimited funds because they have ability to assess not only their policy holders to pay those claims, but they will assess other policy holders throughout the state in order to pay those claims.
Have you seen any liability companies respond? Because did you hear that they went ahead and just paid, right up front, the liability for the D&O and the general liability paid out on Surfside, Champlain Towers South?
I think that they figured it would probably be easier just to pay the face value on those policies versus the class action suits that were definitely going to be coming if they didn't. So I'm not an adjuster, and I don't have a law license. So I can't say for sure, but if I was to speculate, I would imagine that they figured that might be the easiest way to get around it, but especially in the public eye, the way that it is. I think that was probably a smart move on their part, just to pay the face value of the policy and be done.
Otherwise, they would have been paying all these things out in attorneys just to defend themselves. Can you imagine?
And then it's like the big bad insurance company is denying a claim and all these people died, and it just would have been a bad look. So I think they just chose to just pay it and be done and then exit the state, which is what Great American did. So as far as condo association goes, right now we have about a dozen carriers that are actively writing new business. That's excluding like the Lloyd's of London type layered products. There's of course further restrictions based on type of construction, like frame is always a hard one. Total insured value. If the total insured values are too low or too high, it might not fit the program. Number of stories is a big one after Surfside. Some carriers are saying, well, we're just not going to write anything over 5 stories anymore. A lot of them are saying that.
Wow.
Barrier islands is always an issue, and short-term rentals, in addition to claims, is something that has to be taken into consideration for all those. But out of the dozen or so carriers, generally of those, 2 of them require the year built to be 2000 or newer. Another 3 require 2002 or newer. One of them said 2005 or newer if it's joisted masonry. And then for roof ages, out of those dozen or so.
Oh, that was building ages?
That was building ages. Year built. So all those are ones where 2 said year built 2000 or newer, 3 said year built 2002 or newer, 1 said year built 2005 or newer if it's joisted masonry. So, right there, that's knocking out a ton of associations that were built anything, anything prior to 2000, we're going to have a harder time finding it. And then it gets smaller as we look at, okay, do they have short-term rentals? Is it on a barrier island? Is it more than 5 stories? Is it frame construction? Like that pool just keeps getting smaller and smaller. And then when it comes to roof age, one of those says they prefer roofs within 5 years. One of them says, and the majority of them are starting to lean towards roofs within 10 years. That's really what they're kind of beginning to look for. Another one said roofs within 15 years. 2 of them said within 20 years. But it looks like the direction that they're going in, they're preferring roofs that are within the last 10.
Wow.
Yeah. And then some of the carriers are now also requiring engineering reports if the building is 40 years old or older. They want that engineering report. They want to read it. They want to see if there were any issues, and they want to make sure those issues were taken care of. Otherwise, they will not provide a quote. They will not allow us to bind.
So I wonder what these engineering reports are they charging for this?
I have an association right now that's getting bids for them, and they're all charging for it, and they're not going to be able to get it done anytime soon. So that's another issue is, okay, you've got a renewal that's coming up in 3-4 months, and they're saying, well, it's going to take us 5 months, 6 months to get out there. Well, what are you going to do? And I'm waiting to see whether or not the carriers will give us a grace period in order to get it. I mean, because that's the issue, is now so many people are contacting the engineers for these inspections. They're backed up.
Wow. It's like a trickle effect.
It is. And now HOAs is even harder to find property coverage. So remember I said we had about a dozen carriers-ish to go to for condo associations. For HOAs, for property coverage, we only have about a half of a dozen. And those have obviously the same types of restrictions, barrier islands, any short-term rentals. Even if it's an HOA, short-term rentals still hurt us. Number of stories, construction, etc. But out of those 6 or so carriers that we have, one of them wants the year built 2002 or later, and 2 of those want roof age within 20 years. Okay, 20 years, it's not too bad. But I mean, these are often HOAs with clubhouses, and a lot of those, they've never replaced the roof, you know?
Right, yeah.
So having to go and say, okay, well, if those clubhouses or the community was established prior to 2002, they're not going to look at it at all. Or that clubhouse or that bathhouse or that guardhouse that just has that tiny little roof on it, you're still going to have to get it replaced because the carrier won't write it because it's too old.
And a lot of the people saw a lot of this already when they put their budget together this past November, before November. But I think why you and I are talking about this after that is that it seems to be it's getting worse than better. Since the last time that I spoke to one of you guys, which you did your CE class in November, didn't you? On the CAM Matrix?
So. Yeah.
And so it's gotten worse since November, right?
There's definitely more tension. And I'm not seeing any relief yet.
Right.
I'm seeing the market continuing to harden. And there was some rumors last year that, by the end of 2021, it's going to start softening a bit. I just don't see that yet. The carriers still seem like they're restricting and they're not expanding. That's always a sign of a hard market, is the carriers are not going out being super hungry for all types of business. It's not the competitive marketplace that we saw prior to 2017, where we had a lot of carriers and they were all fighting for this business. They're being a bit more timid with it. We're still seeing non-renewals and we're still seeing carriers exit the state. So
I think this could probably go on for another 5 years at least, right? I think going.
I don't know about 5, but I feel like at least 2. You know, before it maybe stabilizes.
Yeah.
A little bit.
It seems like every now and then you'll have a company that'll come in and say, "Well, we'll give it a shot," you know, because we know we can write a bunch of business, and we'll just kind of. What the insurance companies will do is they'll say, well, we'll write so many over here in this area, and we'll write so many in this area, and we'll kind of spread out our risk, and we can make a profit doing that. I just wondering from your standpoint going into next year's budget season, I know we just finished this year's. It's a long way away, but can you kind of tell the managers, can you give them any advice as to what they should think about?
I think going with what I've been seeing as kind of the average, and other industry peers of mine have been seeing 20 to 25% on average. So if you want to do 25, that might be a little bit safer, but I wouldn't budget less than 20. I think that would be a risk. And if we're able to find another market that wants to pick you up, great. You know, then you'll have a little bit of a surplus sitting there. But I would recommend budgeting at least 20% on the total line item for insurance, just because we don't know what these insurance companies are going to do until they do it. And by that point, it might be past your budget. And if we have to find you a replacement carrier, that tends to be the worst option. If they non-renew, if they exit the state, you know, that's going to be a hard thing for us to try to find replacement coverage when there's not a whole lot of movement right now between carriers.
What's the highest deductible you've seen? Not windstorm, but I guess, windstorm.
Yeah, I mean, that's really the only one that makes much of a dent in the premium is on the hurricane deductible or on the wind deductible. 5% is really the highest that we've heard that you can go that will be acceptable to unit owners' mortgage companies. That's always the issue. So Gotcha. If the documents don't require the insurance, which typically they do, so you can't self-insure, then the state of Florida requires the insurance, or the DBPR, or the lenders that are providing the mortgages or lines of credit for the units. So there's a lot of different entities that require coverage. And so that makes it difficult for an association to say, okay, well, we're going to trim the fat by dropping this or dropping that. You have to be very careful and review your documents, talk to your association attorney about it, and see what can you do and what can't you do.
I have been dying to get you back on to talk about flood, but from my understanding, there's so much going on with the flood that it's just, you were kind of waiting for it to settle down, and because you needed to dive back into it.
Well, I would say if you are including the flood, when I just said budget 20% increases, then you should probably be okay, because flood rates are capped at around 18% per year if you are with the FEMA National Flood Insurance Program and you have uninterrupted coverage. That's the thing. You didn't leave to go to a private market and then come back. Like, your renewal with the NFIP is capped at about 18%. So if you do a 20% increase on your full line item for insurance, you should be safe on the flood too. Where people are getting into trouble is if they let their NFIP policy lapse.
I was just going to say that.
Back, yeah. And now it means whether it lapsed because you decided to take some savings with a private carrier outside of FEMA, or whether it lapsed because you forgot to pay the bill, when you come back, you will be charged the full risk rate according to Risk Rating 2.0. And that's their new rating system that they rolled out October 1st. And so anybody that purchases a new flood policy, whether that means brand new, you never had one before, or because you had a lapse, you're going to get that full risk rate. Everybody else is on a glide path. So you're going to be kind of going like up until you reach whatever that full risk rate is, but there's that rate cap every year. They can't charge you more than that 18-ish% more than the year prior. So if you have a private flood quote on the table that you're reviewing, make sure you ask your agent, okay, what would my full risk rate be with the NFIP if I chose to go with this, and then maybe I had a claim or even didn't have a claim and this carrier just decided they want to non-renew me next year? What am I looking at to get back to FEMA? What does that price look like? If it's not that much more, then okay, maybe it's worth the risk. But if it's astronomically more, some of them that I have seen is 800% more, then maybe it's not worth jumping ship for that 20% savings when you might have an 800% increase if they drop you.
And it's so unpredictable as to what the markets do. I mean, they literally can decide we're pulling out and they're gone, just like what has happened here this past year with the other markets. Yeah, that's not worth it. You kind of have to stick and stay and scup the.
It's worth looking at the risk and seeing, okay, what are we looking at? If we decided to exit the NFIP, what would we be looking at if we had to come back?
Well, thank you for being here. One day you and I are going to get together when things calm down and we're going to talk about flood zoning, because I know that's your favorite topic.
Yeah. So much fun.
The condo queen, as she's known over at Insurance Office of America, you guys. If you have any questions or you need help with your insurance policies, and if you just need some advice, Michelle's a great person to reach out to. She'll tell you like it is. She's not going to try to sell you something you don't need. And you can chat her up on the CAM Matrix at Michelle Newton, Newton. And she is with Insurance Office of America. And because they're statewide, she can pretty much help anybody wherever they're located. You guys have offices in Florida, and you have them in Altamont Springs still? Are they still based in Altamont?
I think we've got 20 something locations in Florida now.
Wow.
And then we've got them all around the United States too. But I specialize in just the condos in Florida. I'm not trying to branch out too far.
Yeah, right. Yeah, no, we're not talking to anybody outside of Florida. Thank you, Michelle. Thank you for being here with us today.
You're welcome. Anytime.